one, and we are recording. All right, Sam with Zeal Team Trading. How you doing, man?
Hey Jackson, how are you guys? Thanks for having me, man.
Doing well, man. Doing well. So, for the viewers' sake, here, Sam and I mean, we've known each other for about 3 years. Met you on Instagram. I think I slid into your DMs. We started chatting because you run Zeal Team Trading. Obviously, me with Stockpilot. We started chatting back then, and then asked you to be a guest on the show, and here you are. Glad to have you on here, man.
Yeah, thanks, man. Yeah, I think you were speaking with one of my previous business partners. He ran our social. He ran our social for a while, and I think we've kind of closed down the social since then. So I'm not big on the social media, as a lot of people. A lot of people come to know I'm not very good at it, and it's not really my thing.
All good as long as you're good at trading. That's
Yeah,
what counts.
that's pretty much all that matters, right?
So we'll get into this like how I normally do. I have a list of questions here. Sam does not know the questions beforehand. We like to keep it unscripted. So we start off light here. Interview or background. How'd you get into trading?
So my story is going to be a little unique, and I'll try to make it as quick as possible.
Take your time.
My father was not so much, I'll say, a trader. He was very involved in the financial market on the pre-IPO front of thing, involved in taking a lot of companies public. So he had me introduced to financial markets at a very young age. Never really was a top frame of mind. I was a golfer growing up, and that was actually my first career. I played professional golf on the Latin American tour and
Wow.
the Canadian tour from the time I was 19 till roughly about 24, and then I tore the labrum in my shoulder, and my game never really peaked to back to how it was from that. And I just had other goals in life, and I got involved in finance and ended up taking a job in Amsterdam on a desk at a fund over there, and traded European cash equities with them for roughly about two and a half years, until I started missing home, and ended up moving back here to home's Montreal, Canada.
Dang, man, nice, man. That's pretty crazy. I didn't know that about you.
Yeah, 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 yeah.
Amsterdam, man. That must have been a good amount of fun.
It was a fun time, man. At times it was a little dangerous. You put a 26, 27-year-old there. It's a beautiful place, though. The people are awesome. It's a great culture.
That's what I hear. I've a friend that's actually in a metal band. He goes on tour a lot. He's on tour right now, actually. But out of all the places, I asked him like, "What's the best place over there?" He always says Amsterdam, and he doesn't do any doesn't partake in any of that type of stuff. But like he said,
Yeah, no,
Amsterdam.
I mean it's a great party scene. It's a great family scene as well. I mean, I would love to go back and live over there if I could get the whole family to come with me. That would be, I'd be there in a heartbeat.
So moving on to the next question. What was the implication on the global pandemic, and how did it change your investment strategy since before the pandemic?
So, I mean, the pandemic started some fun things. I'm sure everyone's aware of that, right? The how should I say this? The traders and the new traders just came out of the woodworks during this pandemic, right? We had QE infinity, we had zero interest rates, money was free, growth tech stocks were just climbing, right? And that's what a lot of the newer traders saw. They didn't see the events leading up to the pandemic or necessarily the crash in the pandemic, right? They saw the effects of the pandemic, right? This QE program, the shift in monetary policy to, pretty much try to jumpstart the economy again. Um, so for me, I've always been a multi asset, multi strategy trader, right? My focus is on global macro, kind of a top down approach on global macro. The main thing that drives my trading is changes in monetary policy, economic data, interest rate yield differentials between countries on their currencies. This is my main focus. So leading up to COVID, it had been a slower time. There wasn't a whole lot going on in that space. The COVID crash obviously sparked some huge opportunities there. But then emerging from the COVID pandemic, it sparked, I mean, some phenomenal opportunities in the growth space, in the equity space. And I found myself trading a lot more equities, and even found myself too trading some of these out of the money options during 2020 and 2021. Um, And since then, that train kind of peaked out, was able to spot kind of this change that the Fed wasn't going to be able to continue this ultra loose policy, and kind of readjusted the trading strategies. Figured, okay, long long growth is not really the place to be for the next couple of years. So yeah, went back, and kind of this whole thing kind of brought back global macro. Global macro has been kind of dead for a decade, right? If you were a money manager in global macro, you got all your allocations taken away from you if you stuck to the script the past 10 years. Everyone started putting their money with growth managers, Kathy Wood's Art Fund, anyone that was chasing these, duration sensitive, high growth names that prospered. And it was a phenomenal, phenomenal trade. But the story's kind of changing there. And it seems to me like global macro's coming back to life a little bit. Hopefully it lasts. So I think that's kind of how the pandemic shifted the trading. I mean, I found myself doing a lot more day trading, to be honest, during the pandemic. A lot more day trading in these, higher ticket tech names, your Amazons, your Teslas, right? They were moving. It's hard to not trade these things when you see them ripping 10, 15, 20 points in a day. You can go, even though you're paying up at like a 70 vol and buying a 20 point out of the money call option that expires in a week, the thing still managed to finish 50 points in the money. It was just, it was an absurd time, and it was phenomenal, right? And I think a lot of newer investors right now that came into the market just during these times are having a really difficult time getting away from that mindset and shifting into the new market regime we're in, right? Like, markets trade in cycles. We were in one cycle, we're in a new cycle. We're going to come out of this cycle and start a new cycle, right? And it's our job as full-time traders to kind of identify and position for the cycle we're in, but most importantly, identify what cycle we're moving into.
Makes sense. Definitely makes sense. It's almost, man, like a almost a bad time to have gotten started during pandemic because everything was so good, and it's like, all
I
right,
think it
now it's
created
off.
a it was I think it created a lot of false sense. Being involved in the trading community with zeal. I see it. We see the different people come in, right, and I never like to sell a hope and a dream, right? Everyone comes, joins these, trading communities thinking, okay, Sam, how can I make $1,000 a day off my cell phone, right? Like, and it's like, you can't, it's a hope and a dream. There's like, don't be the Instagram trader, right? I gotta say it. That's kind of my thing. I mean, it's a long grind, and trading is hard, right? I mean, I sit in front of my screens probably from 6:30 in the morning till 6, 7 o'clock at night on a daily basis. There's a lot of time put into this. I definitely think it's a hard game to get into. So sorry, I'm getting a little I'm rambling here. I tend to do that, but
No, you're
I
good.
think it's important to set people's expectations right, not to sell them like a hope and a dream. Trading's a very difficult thing. In this environment, it's extremely difficult. It's not like it was, in 2020. And it's funny we bring that up because I think a lot of the more experienced traders actually underperformed in 2020 because they couldn't believe what was happening. Like, how can this really be going on, right? And then you had the newer traders just starting out, opening their Robinhood account, right? Just YOLOing these out of the money calls, making just handfuls of money. And it's just like, it was a fantastic time. I'm sure some people took great advantage of that, but you'd hate to see a lot of these guys come now and give back everything they were able to do, because they don't understand the dynamics of the market or kind of these regime shifts that take place.
Well, the funny Chuck and I talk about this all the time is like when we when we started Stockpilot, we reached out to a lot of trade communities, got into like kind of
Mhm.
the Discord realm, and there were so many clubs, so many trading servers, and now it's like there's a handful. There's not.
There's a
They're
handful.
all dead now.
And it's
Not
funny, man. My Twitter feed, like Twitter, now that Elon bought it, I mean, I get notifications from people I don't even follow. I don't even know what's going on with that. I open Twitter, it's just a bunch of people I don't follow. I think I follow like 71 people, and for some reason, I get all these names on here that I don't see. And I can tell I could not look at markets for a week and know the direction by the amount of people that start tweeting. When the I know the market's going up, but people are starting to come back on Twitter. It's hilarious.
there's got to be a
It's
bot for
almost
that.
like my contra indicator, right?
Yeah.
People start coming out of the woodworks. It's time to short that 4,200 we had in the S&P 500 the beginning of last month, I believe it was. I mean, everyone, oh, it's a new bull market. It's a new bull market. I was like, I'm actually going to load up on some puts here. Just
uh, that leads me to my next question here. So, how have you adapted your strategy to account for the bear run we're seeing?
So the good thing for me, again, like I said at the beginning, being multi-asset, right? So I started in the equity game. I was lucky enough to learn from a lot of guys that were huge in the option space, and they taught me quite a bit. So again, I think it's important being a full time trader. It works for me to not be a one product trader, right? Some people get into their niches. They can scalp options. They can scalp equity. Like look at some of the guys that trade the backside of these low floats. They're phenomenal at it, right? It's a niche I can't get into. I'm not good at it. Um, but that's the beauty of knowing what you're good at. And I'm good at trading a variety of products, right? And identifying these regimes. So the bear markets for me, I adjust in the sense I'm not really looking for, let's say, longer term opportunities. I'm keeping things on a much more tactical basis. Even for my longer type of plays I'm looking at, I'm still looking at maybe a 2 week, 1 month to at most maybe 3 month horizon. And I think you can see that just because the volatility that comes with bear markets, whether you're trading, equity options from the long or short side, you see the effects of the reverse on these, right? I can be short and I can get blown back out in a day's time, right? With these rallies in the S&P. So a lot of that comes into trade structure, right? Trying to identify an opportunity and what's the best product to use to structure my trade idea, right? Is it outright shorting, e-minis? Yeah, probably not. Is it worth putting a little risk budget together and seeing, if I can buy some cheap volatility in the S&P 500, right? And that's kind of what I was doing in this most recent trade that I told you about, right? I was looking at this 4100, 42 area, thinking, okay, this is where people are probably going to start to get a little bullish. These are just kind of psychological levels, right? So that's kind of a good area to get short, but we do have the Fed still in this hiking cycle, right? I was honestly hoping, my original thesis was that none of this would play out till next week. I was hoping we'd extend into 4,200 into next week, on one of the last possible Fed rate hikes, right? They'd hike rates another 25 basis points. They'd pause and hold, and that would kind of spark this quote unquote Fed pivot trade where we'd see the markets rally. That just happened almost month and a half before I expected it to. And I started nibbling on that trade. And the way I structured it was just I went in outright put positions just because I wanted to limit my risk, right? I figured, okay, I can assign this thing a 2% risk budget, right? I'm going to risk 2% of my total AUM. I'm going to add in some longer dated 4,100, put on 1% of that position. As we climb to 4,200, I'm going to put on that other 1% of the position and kind of, vary out these strikes and dates to kind of take advantage of that. And I think that part is just a component of good risk management, right? You'll see a lot of people come in and just quote unquote YOLO options, right? Like, okay, I have a 10K account, I'm buying 10K worth of options. Let's see what happens, right? Options for me are used to manage risk, right? I know my worst case scenario when I outlay that capital, right? So that's essentially what I was doing with this and trying to time this to not really absolute price levels, but options are all volatility based, right? So I'm essentially, when I'm taking a trade like this, I'm trying to buy cheap volatility, right? And to me, cheap volatility can be looked at a couple of different ways, right? It could be realized volatility trading under implied volatility trading under realized volatility. To me, that's a signal that technically vol's kind of cheap, right? Vol's cheap. So it's a good kind of risk reward to own some puts in that scenario. Can also combine this just with kind of absolute levels in the VIX, right? We were in a regime where we were trading mostly above 20 for the majority of the year. At that time, we had cracked down sub 20. We also had the skew index, which measures tail risk in the market, relatively low. The move index, which measures bond volatility, was also relatively low at the time. So I figured, hey, all these kind of things are matching up. It's a good time to kind of put on these trades.
Interesting. Okay. Um, what do you think about index funds versus more active styles of trading in this economic environment?
So, I mean, I think that's going to be completely on the person, right? I think it's what are your financial goals, right? Are you looking to park money for retirement? Are you looking to put money to work and not look at it for the next 10, 15 years, right? If history's told us anything, 10, 15 years from now, S&P is probably going to be a lot higher than it is right now. So, perfectly fine to put some money to work there. You don't worry about, you know, the month to month, quarter to quarter, day to day fluctuations in the market, right? As a more, professional risk seeking trader, I guess as a trader, I believe there's a lot more opportunity on a shorter time frame, right? Let's say I'm just an investor and I have $100,000 and I park it in the S&P 500 for the next 5 years, right? Maybe I get maybe I make an average of 10, 12% a year, based on inflation, right? My real yield on my investment. But then think about this. If I look for these, shorter term allocations, right? A month here, 3 months there, and I take that same 100 grand and I can make 10% on this trade, 5% on this trade, 20% on this trade. Well, then, amortize that over 5 years. I've made a lot more with my money than I would have just parking it in an index fund. Now, doing it that second way does obviously entail more risk, right? So it's really what are your goals? Why are you investing this money? What do you want to get out of it? How much risk are you willing to take, right? If you know, you have a solid, career path, you're all set, you have some little extra play money, maybe you want to be a little more aggressive, right? It's not going to kill you if you lose it. If, you're just coming out of college, getting your first job, probably not the best thing to go hit the markets heavy with that. You probably want to start building a little safer portfolio, thinking about your future.
That's very responsible. Honestly, like it's because a lot of these online traders, not saying you're just an online trader, but like that they would say like, oh yeah, just trade options. But like you're like, no, what are your goals first and foremost? Like how
Well,
old are you?
that's the big thing. It's what are your goals and what are the risks? Options are risky, and it's funny that people do this, right? I'm going to go on. I'll just give a little spiel here to what I think the newer traders should do. Okay, you have options derivative. My opinion, the most complex products that are traded. You know, equities are pretty straightforward. You know, there's not all these factors that affect them, right? So you have newer traders getting introduced to the market, trying their hands at one of the most complex products, right? So, and they say, okay, it's for the leverage. I get that. I get that. Um, but a lot of people don't know, futures, right? And when I say futures, I don't want to confuse people, right? You can trade futures, index futures, interest rate futures, bond futures, whatever it may be, euro dollar futures, SOFR futures. I do a lot of trading in those, but margin requirements for those, that they're not astronomical, right? I think to trade one euro dollar, which is LIBOR rates, it actually has nothing to do with the euro USD currency pair. I believe the margin requirement for that is $1,000. Okay, you can have a $2,000 account and trade in LIBOR rates. Okay, 1 basis point move is $25. So I think, why are people coming into these complex products where they have to worry about their timing? They have to worry about, not only time decay, but they're buying expensive volatility, which decays, right? You have Vega exposure. You also have these secondary Greeks, Vanna and Charm, right? Charm can work to your disadvantage, right? That's just a decay of delta through time. So you have all these odds working against you, and you're trying to put on these trades where if the market goes sideways and your timing's not perfect, you're losing money, right? I could buy, let's say I come into the market and buy one S&P future at 39.50. You buy the 4,000 call in the index options expiring 2 weeks from now. The market trades sideways for the next week. Then we spike up 5-10 points, let's say. We make a 5-10 point move over the course of a week. You're down money. You had your direction right, but your timing's off. Those in the futures, there's no time decay in that aspect. So you're still up. So I think it's I think it's this mentality again that spills back into the COVID days of options are the best way to go, that you can put up very low amounts of money and turn them into astronomical numbers. And some people were able to do that very well. I'm sure some people can still do that really well, but I think it's very difficult for newer traders or less experienced traders coming into the market to be able to do that successfully. I think you're kind of you're setting yourself up for failure. So I think there's easier ways and easier products to trade for someone coming into the market and trying to get a feel for it.
Almost a walk before you run type situation.
Exactly, right? Like, and that's what we try to do, right? You can lead a horse to water, but you can't make it drink, right? Like we can talk to you, give you guys all this advice. I've seen some people come in, to our community that have realized this and they've done extremely well, right? I've seen guys that just have no interest. They just, they want to gun ho these options. And I'm not saying it to be rude or anything, but about 90% of those people that I see come through our room, they last maybe about a month or two and they're back out the door.
All right. So, are you fearful of the bond yield inversion?
No, I don't think so. Now, there's a debate I've been asking myself, right? Everyone talks about these yield curves inverting, right? We've had the two tens invert. We also had the 3 month, 10 year invert. I was paying attention to a lot of the forwards when the Fed 6 month, 18-month yield curve inverted. That was a scary sign. Um, but you have everyone coming out and talking about, okay, does the yield curve, signal a recession? Right? Does the yield curve signal a recession? I'm going to go ahead and make the case that does the yield curve cause the recession? Right? Because essentially what happens, right? Think about the financial system and how banks work, right? This is a perfect case for what's been happening with Silicon Valley Bank going up too. Banks loan money in the long term, right? And they fund in the short term. So when interest rates are higher in the front of the curve, right, like the 2 years much higher, banks are paying more of a premium to, fund their long-term loans that they're doing. And they're funding those long-term loans at a lower rate than the short-term loans. So essentially, it's bad business for the banks. And that essentially leads to less credit creation, right? Less credit creation leads to consumers spending less money, leads to a slowdown in the economy. So that's been kind of my question. So, yes, does the yield curve signal a recession or does the inverted yield curve actually cause the recession?
Okay, interesting, interesting. Um,
But yeah, there's been some astronomical inversions. I mean, we're over 100 basis points inverted on the twos and tens. And I mean, just to bring up that point of what's happened this week, I don't know if a lot of people who listen to this will find this interesting, but what I mentioned before, the bond index, the volatility index for the bond is the MOVE index, MOVE. It's pretty much the VIX of the bond market, right? We spiked up to the 198 handle. That is the highest we've ever seen since the great financial crisis in 2008. We had 2 year yields make near 12 sigma moves on an intraday basis, some of the largest moves since 1987 in the fixed income space. So to equate that to people that, trade options or trade equity, the move index at 198, I would equate that to the VIX being in the high 80s.
so a good thing or a bad thing?
Well, just insane volatility. Depends for what side of the trade you're on, right? Like you're hearing a lot come to light now. A couple PMs from Citadel, a couple PMs from Millennium have been let go recently. So I think a lot of these moves that we've seen recently in yields and bond and yields that are intertwined was due to a hell of an overcrowded trade short the front end of the bond curve, and you essentially saw I mean, I don't, a squeeze. You saw a short squeeze in the front end of the bond curve.
Interesting. Okay, okay. Um, Next question here. So, say there's something in the news, a current event, something you see, something pops up, you see it on the news, and you say, "Wow, I want to make a move. with or against that doesn't matter. Um, how do you choose an option contract? How do you choose your strategy? Or I guess how do you choose your option contract if that's the strategy that you're going to go with?
Yeah.
But yeah, yeah.
Okay, cool. So, very simple way. So, a lot of this will come down to personal process, right? Let's say I'm putting on my day trader hat, right? Because this is more of a day trade. Let's say event driven catalyst. I have a strategy that I kind of use dynamic supply and demand, right? I use a variety of moving averages and kind of linear regressions that tell me, where kind of technical bias are going to meet like emotional sellers, right? Kind of key supply and demand. Okay. Um, so if I'm trading options on this, I will look to where my next level of supply is if I'm trading to the upside, right? So let's say I'm looking at Meta, right? Let's say I'm looking at Meta. Meta's trading 196. They announced that they're laying off another 10,000 employees. Well, we know lately any company that has been announcing layoffs in the tech space, the stocks seem to get a massive, massive boost on those. So then I'll just pull up, see, I'll see, okay, my next level of supply is at 202. Well, this is obviously a fast moving trade, right? So I'm going to trade shorter dated options, probably looking for that move more related to gamma, right? I'm going to try to buy a lower delta and have that gamma move in it. I call it kind of the gamma trade, right? Because gamma is the rate of acceleration of delta. So if I'm buying, a 20 delta, I'm hoping it pops up into my next area of supply, which will put me at a 50 delta, right? If that option goes right at the money, it's going to give me a 50 delta. So I'm looking to make about 30 deltas on that move. And that's in a fast moving environment, right? Now, if it's a slower moving environment, I'm more likely personally not to trade options, right? I will trade equity on that just because, it's a slower move. You have factors working against you in options when things move slow. But not everyone can trade equity because of capital requirements, right? So even then, if you have an options account, all you could have to do is buy yourself a little more time, right? Don't trade the weeklies. Don't trade the weeklies. Trade at least the monthlies and buy higher delta calls, right? The closer you can get your delta, the closer you can get your delta to 100, the more it's going to behave like the underlying, right? So instead of going and buying a deep out of the money call, go a couple points in the money. Sure, it's going to cost you a little bit more premium, but you're not going to be as exposed to the decay as quickly as you would buying something drastically out of the money. So, fast moving market, I go for those gamma trades, trading the strikes at my next level of supply, or if it's puts, my next level of demand to the downside. If it's a slower moving market, I'd advise trading, kind of trying to create a synthetic long by buying, maybe a 70 delta, an 80 delta call.
Interesting.
So
Okay.
that would probably, be something 3, 4 points in the money.
I feel like my questions aren't as technical as your answers. Uh, and actually, and for the viewer's sake too, before we started recording, Sam goes, "How technical do you want me to be?" And I was like, "I don't know. It's gonna go over my head, but for the viewer's sake, just lay on them, man. Do it." Um, so, all right. And are you cool? We're running a little. We're at 28 minutes here. I don't know if you're pressed on time. We can run
I'm
another
not
few.
pressed on time at all.
All right, cool. We'll keep this thing going then. Um, how do you feel about how the Fed has been handling rate hikes and their attempts to curb inflation?
I can tell you, I am so glad I don't have Jerome Powell's job. I mean, look, the guy gets a lot of flack from a lot of people, right? But I mean, they are in a very difficult position, right? I think what they've done was absolutely needed, right? I don't think people quite understand, if inflation stays steady at 6%, it's going to 10%, right? We're going to have repercussions of that, right? We've seen it in the wage growth metrics, right? And it's just like this feedback loop. And we were at a similar place that was starting to scare me, right? That we could go back to something that was very similar to the 1970s. And I think unless we have this systemic event, we're going to see inflation become very volatile. We're going to see lower inflation prints, but then we're going to see bouts of inflation spiking back up again. So I think we're in for a longer battle than most people are anticipating right now. Caveat on that being we get a systemic event, kind of like this mini banking crisis that we just saw, right? Unless something like that happens, I think the Fed still has a lot of work to do, right? The most recent data, sure, we've seen some slowing, right? We've seen, the last PPI number come in a little softer. We've seen CPI come in a little softer, right? But we're still seeing this tightness in the labor market, right? Now, the tightness in the labor market could also be lagging, right? There's a couple metrics that I look at here. One of those is the NAB index, the National Home Builders Index. It's a great leading indicator to unemployment. It tends to signal unemployment trends at about a 4-month advance. Now, that could be because the NFP number, about 20% of the NFP number is concentrated into kind of the real estate space, right? 20% of the NFP jobs are kind of sectored into the real estate space. But we've had this huge, huge divergence in NFP and unemployment right now. And I kind of buckled down on this and researched it a little bit. And it seems like a lot of this is coming from the construction side of things. Construction employment is still sitting around its peak of the year. It hasn't dipped down yet. Now I kind of thought to myself, why? Right? Why would construction employment still be high when we've seen this mass slowing in housing activity? Well, what happened during COVID? They laid off a ton of workers and they had a very difficult time getting these workers back. So it's almost a function now of labor hoarding. So then I pulled up another metric to look at and I started looking at hours worked on construction employees. And that's actually gone drastically, drastically down to where we're almost at COVID lows for the hours worked. So that gave me the indication that instead of cutting jobs, they've just been lowering the hours worked. So this is a trend that we're looking to see if it changes, right? If we start to see layoffs in the construction sector, that's going to feed into that unemployment number, right? Which is what essentially the Fed has told us they want unemployment higher, right? Because that's pretty much the only way to slow down inflation is to kill the consumer. They won't come outright and say it, but the Fed would welcome a recession because that solves their inflation problem. So right now, what I believe the Fed is going to do, right? I think they've done everything right so far. They've hiked, they've stuck to their guns. You saw it, Lagarde yesterday hiked by 50 basis points still. She stuck to her guns as well in the ECB. I think we see the Fed do another 25 basis points. What is that, on the 22nd, next Wednesday? I think we see the Fed do another 25 basis points. Then I do believe they're going to pause for a little bit and kind of say, okay, we're going to see kind of the implications of these past hikes. How does it start to affect the real economy? And they're going to be very data dependent. If the labor market remains tight, that's going to feed into inflation. So they have to continue to hike rates. And if a couple dead bodies are going to come up and fall, so be it. It's kind of the name of the game, right? And you look at this SIVB thing, right? The Fed didn't cause SIVB, right? They didn't have their interest rate risk hedged at the end of the day, right? They didn't have any interest rate risk hedge. And every major bank, anyone who's in the investment banking or investment side of banking knows you have to hedge your duration risk. You have to. So I don't think the Fed can be blamed for what's happened with the banking crisis, right? I think anyone that owns a bunch of Tesla or ARK is going to argue that point and say that the Fed caused it and they need the Fed to cut rates so their stocks can go to the moon again. But I just don't see it. So I think the Fed's done a very good job at that. And this goes back to that multi-asset trading, right? This creates a mass amount of opportunities in the market, right? When we're talking earlier about trading, euro dollars, LIBOR rates, which are transitioning to these, SOFR rates, there's been immense opportunity in trading these products around the speculation of the Fed, right? Like, look how the pricing was just in the past 2 weeks. We went from the market pricing a 50 basis point hike to no hike at all to 25 basis points. This creates a ton of volatility in these and creates some fantastic trade opportunities if you kind of understand the dynamics of what's going on and, the probabilities of what's most likely to play out.
So, do you think with these attempts to curb inflation, you kind of already answered this, but I'll ask it. You think we'll have a soft landing?
No. No, I think soft landing's out of the question. I think you're looking at a hard landing no matter what. Now, how deep that recession gets, I'm unsure, but I think you're looking at a hard landing, right? The Fed is infamous for hiking until something breaks. Now, I don't think this was the break. I don't think this SIVB story was the break, right? I did underestimate the fear that it would spread to the market. I thought it would be contained, and then when we started to get these bailout programs, well, not really bailout, but these funding programs to help back the bank, I thought that would kind of rein it in a little bit, right? But then we saw, the developments with Credit Suisse. I mean, Credit Suisse has been in the hole since 2018. They've been in trouble, right? And I think this brought to light some new things. I mean, you saw their credit default swaps trade over 1,000 basis points wide. I mean, huge blowout there, which is quite scary. So I did underestimate how much it would spread, but I don't believe this is the event that breaks it. But to play the opposite side of that, right? I always like to look at two sides. I never think my opinion's right, right? Anytime I have an opinion or a trade I want to put on, I have to look at the counterpoints to it and see how I could be proven wrong, right? And this goes back to the component of credit creation, right? What just happened with these banks is probably going to lead to less credit creation, which in a sense is going to help curb that inflation a little bit. Banks are going to be tighter with lending. But then you play the flip side of that too. You look at this new BTFB program that the Fed just implemented, right? What shocked the markets today was the fact that their balance sheet just boosted back up to levels we saw in November and pretty much wiped out the past 4 months of quantitative easing that we just did. So the waters are murky. It's a very tricky spot we're in right now. I think it's a very difficult situation to try to grasp and kind of predict what will happen. I think being reactionary and tactical is really the best thing you can do here. But simple answer short is I don't think we've seen the worst yet.
Uh, the best is yet to come.
I think the best is yet to come. I think we have to go lower, right? And I don't want to get too complicated here, but look, the S&P 500, if you want to price it very simply, it's based on 12-month forward EPS, and you assign a forward PE to that, right? So if we have a forward EPS in the S&P 500 of $220 a share, and you assign a 20 multiple to that, well, the S&P is trading around 4,400, right? We were sitting right around a forward EPS of about 220 in the S&P, right? Now, EPS growth just went negative last month. So I think, with the Fed trying to tighten and cool inflation, EPS has to go down, right? Earnings per share is going to go down. Now, how deep we go down, 5, 10, 15, 20%, I'm unsure yet, right? But I do know every time the Fed has got terminal rates to 5%, the average PE ratio in the S&P has dropped to 16, right? So even if earnings per share only declined by 5%, that puts us at 210, right? A 210 EPS with a 16 multiple puts the S&P at 3,360, right? So that's kind of a base case for me, right? And if you look at the previous low we put into the market, I think it was right around 35, 3,600. PE ratios dropped a slid bit under 16 right there. And of course, that kind of marked the bottom last year, and we got a pretty decent bounce off of that. So not all loom and gloom, guys. When this does play out, it will create some phenomenal buying opportunities, right? And a very simple, if you're a calm, patient investor, I mean, the easiest way, not the easiest way, but you want to take a simpleton approach to it, is wait for PE ratios in the S&P 500 to dip below 16 and start allocating some capital,
Cool.
especially if you're in it for the long run.
So we're approaching the 40-minute mark here. I have a couple questions that kind of sign off questions.
Okay.
So what are some new things you're working on? Any new projects you're adding to the Zeal team, your community? Anything you'd like to talk about?
Yeah, so one thing we just recently added was a lot of gamma stuff in the S&P 500, measuring, essentially giving out gamma levels, right? So it's pretty much just, I don't want to go too long on this because these are wrap up questions, but essentially it's just building out graphs based on dealer exposure to the S&P 500, based on Delta One hedging strategies, where dealer flows kick into the market, right? Dealers hedge the S&P by shorting or buying futures contracts, right? Clients buy puts from market makers, dealers Delta One hedge that by shorting futures. Now, these concentrations of gamma act as support and resistance in the market, right? And dealers' hedging activity will change depending on the notional amount of gamma they're exposed to. When they have large amounts of negative gamma, which we've had recently, their flows will help expand volatility. I mean, as the market goes lower, they have to short more. As the market goes higher, they have to buy more. So we try to calculate and identify where these concentrations of gamma are, and those act as very good support and resistance levels in the market. Today, prime example, tricky day with quad witching and all this expiration, but there was large concentrations of gamma that would equate to 4005 in the ES, which is where you would think if we traded up to there, that would be a good spot for a mean reversion trade, right? Dealer flows are going to be hedged. The market can kind of move back lower. I think we put in a high of about 4010 today in the ES before we mean reverted back. Another large concentration of gamma was at 3930 in the ES. So we had this box between pretty much 4,000, 3,980, and 3,930 in the ES that mark these gamma spots. And the S&P tends to trade within these boxes. So being able to identify these areas of gamma and understand how dealers are going to hedge with that, and pair a little bit of volatility into that, can set up some really phenomenal trade opportunities. And again, feeds into the question of strike selection, right? If I'm going to be shorting the S&P at the top gamma at 4,005, and there's a lower concentration of gamma out there at 3930, well, I'm going to go ahead and buy that 3930 put strike.
Hmm. Man, you know your stuff, man. Have you ever tried trading? You
Yeah,
should try
I've,
some.
I've been known to dabble.
Oh man, that's awesome. I need some heavy hitter questions for you uh, next time around here. Um, so last question here. Can people contact you, and if so, how?
Yeah, I mean, you can reach out to us by email at thezealtrading@gmail.com. You can shoot me a DM on Twitter. That's at zeal underscore trading. And I do believe, I mean, we don't have a very up to date website. It's just a very brief thing, but that's zeal/trading.com.
Okay, is that like a slash or like a
No, like a little, the
hyphen?
sideways, a minus sign.
Hyphen. Zeal minus trading, right?
Yeah, zeal minus trading.
All right, cool. Well, hey, Sam, this was a great episode. This is one of our longer episodes. Definitely one of our more technical episodes as well. Thanks for doing it, man. This was awesome.
Awesome, Jackson. Yeah, my pleasure, man. Anytime you want to dive into any more of these subjects, more than happy to talk about this stuff.
Absolutely, man. Thanks again. Have a good weekend and happy St. Patrick's Day.
You as well, man. Have a good night.